In this video, I will show you the complete framework I use to pick and analyze stocks to outperform the market in the long term. I've been using this framework for years. I've been investing for almost a decade, and I have achieved a performance of 24% annually. So if you don't know me, if you're new to this YouTube channel, welcome. My name is Christophe Nour, and my goal with this YouTube channel is to make you an intelligent investor, a better investor. Let's start. When you want to invest in stocks, when you want to outperform the market, if you want to beat the S&P 500, where do you start? You start to generate new ideas. Okay, where do you find ideas? That's a very good question. You can start with the ideas that the stocks that you are familiar with, the companies you use regularly. You use your toothbrush, you use your TV. What is the brand of your TV? You have an iPhone, so you can start analyzing Apple stock. You use Facebook, Instagram, everything. You get me? Start with familiar companies, the companies you know very well, because you are a customer of these companies. So you know what the customer experience looks like. You know if a business has a competitive advantage or not. For example, if the price of my iPhone goes up by 10%, will it prevent me from buying another phone for my next birthday, for example? Or if it breaks, no. If it goes up by 10%, I will buy an iPhone. I will buy the same iPhone. I don't care about the 10% appreciation of the price. I will continue to buy. This is a competitive advantage. Maybe I will not say the same about my TV or my microwave. I don't care. Frankly, I don't care. So yeah, start analyzing with companies you're familiar with. Don't worry about the analysis, the metrics. I will give you everything in this video. So you start, where do you start? With the companies you're familiar with. Or you can use screeners. And actually, let me show you exactly how to do it. I'm using FinChat for this one. FinChat is a great website. I recommend that you use it. If you want to use it, I have a link in the description. You can get a 25% discount, 15% discount, something like this. Anyway, and you can have a screener. How do you find great companies to outperform? You can use several metrics. What I prefer is revenue growth superior than 5% per year for the past 10 years. EPS growth superior to 15% for the past 10 years. And return on equity superior to 15% for the past 10 years. You can use several metrics. Instead of return on equity, you can use return on invested capital, ROIC. Instead of 15% for the EPS growth, you can use 20%. I mean, depending on your risk tolerance. But I can play with some numbers, and I have here a big screener. I want stuff to be global. I want the, let's say, diluted EPS. What did we say? 15% per year for the past 10 years. So the CAGR, compound annual growth rate, 15%. Okay, let me speed up the process. You have revenue growth. Revenue 10 year, you want 5%. And you want return on equity. You can use return on equity, return on investment, return on invested capital, return on capital employed, anything. You want it to be, what did I say, 15%. You can use 15, 20, it doesn't matter. Okay, you click on Run Screener. Let me put my face in small. Run Screener, and I have found 250 companies. That's the minimum. I think that you have an even greater number of companies. And if you think there are too many companies and you are lazy and you don't want to analyze all of them, check all of them, you can increase the metrics. Instead of revenue growth, instead of 5%, I have 10%. EPS growth, instead of 15%, I have 20%. Okay, now again 250. Okay, diluted EPS growth, if you want, you can put 30%. 250. Revenue growth, let's put 15%. That's an infinite game, and at the end of the day, you will see some numbers of companies that you like. Here, you see, it starts to decrease. Now I can increase this again also. I have 142 companies. These are all great companies. And you have companies like Nvidia, Netflix, Arista Networks, so companies in the US. You have also companies in China, companies in Sweden, US. If you only want to focus on the US, you can just put United States here, and instead of having 142 results, you will have 11 results. Yeah, that's way smaller. Okay, but remember that this is some very strict metrics here. You have 11 stocks. Analyze all of them. And how do you analyze them? Don't worry, this is the next part of my video. So okay, for your idea generation, one, check the companies you know that you are customers, etc. Two, run a screener. That's very easy to do. Adjust criteria for factors like market cap. Yeah, you can adjust whatever you want. If you want to find the next Amazon when it's a small cap, a mid cap, a small company, you can just put here as a screener market cap here, and you put a threshold of $3 billion. I have two companies that are small. Debt to equity, maybe you only want to invest in companies with no debt, with a lot of cash. Geographical region, well, we put the US. You can put any metric you want, literally, depending on your risk tolerance, depending on what you want to find in a stock. Okay, now you know where to find great stocks, which is maybe, that's a starting point, and that's a very important starting point. Now, continue step 2. Understand the business. Now, imagine you are here, you have 11 stocks. What do you do with these 11 stocks? The goal is to understand the business, not to go too deep in the numbers, but the goal is to dismiss the investment idea as soon as possible. You want to take a pass, and then a pass, and then pass, and then find a great investment and go deep on this one. But in the meantime, you take a pass, and a pass, and a pass, and you dismiss all the investment ideas until you find your golden nugget. Okay, step 2, understand the business. Research how the company operates. What do they sell? What do they do? How do they make money? Is this recurring? Like every year you have to buy the same stuff? I don't know, a chlorine chemical for a swimming pool? That's recurring. Either you buy the chlorine or your swimming pool turns green, which is not cool to see. So yeah, check the business model, seasonal, etc. Who are the key stakeholders? Take a look. Who are the customers? Is it you? Not you? That's now you start to get the importance of starting with the companies you're familiar with. Take a look at Spotify. Who are the main customers? That's me. That's you. That's everybody who likes the music and doesn't know anything about Apple Music or something. We have Spotify. It works. This is purely recurring. I pay on a monthly basis. That's it. And what do they sell? Subscription, access to music. So that's why I said at the beginning, start with the companies you know. Who are the suppliers? Who are the employees, regulators? In which country? How do they work? Like, don't do a deep dive. Do a shallow analysis of, okay, how do they make money? How do they operate? You can use several resources to find this information. You can check the annual report. Just check the name of the company on Google. You put annual report. It will get you to the investor resources of a company. You can look for the investor presentations. Look at this, Spotify investor presentation. Here, this is the full event. Let me check the first link, investor relations. Where is it? Shareholder deck. Is it this one? Yep. First one. Okay, and the management prepares some good resources for you. Okay, explain how everything works, etc. That's great. And you have all the information, the plans, how do you make money, the trending charts, etc. That's very, very convenient. You have blogs and forums for deep insights. I would add to this that you can go to Guru Focus. Oh wow. Guru Focus Spotify. I don't know why when I spoke it was rewriting some stuff, but okay, very well. And Goal Focus is maybe my favorite free website. You have a lot of metrics when it comes to Spotify. You have a small description of the business. Okay, what do they do, etc. You have some metrics here. You have some charts here. You have the revenue growth over time, net income growth over time. This is not making money at all. Okay. You have the cash, you have the debt, you have the cash flow they generate, free cash flow, operating cash flow, the return on invested capital. You have a lot of metrics. Take a sneak peek. Take a look. And for 11 of your businesses here, you can start with Arista Networks. This one. The ticker symbol is ANET. ANET. And what I would check is all of them. 11 of them. Okay, let me check everything. The margins. Okay, free cash flow margin. This is the growth. You see, this is up and to the right. Most of the businesses you will find with these screener, these are great businesses. These are great businesses, up and to the right. Revenue up and to the right. Net income up and to the right. They are getting more profitable and more profitable. They don't have any debt. They have a lot of cash and they produce a lot of free cash flow. Free cash flow is what matters in the long term. They have a growing return on invested capital, which is very good news. So the business is getting more efficient and more efficient and more profitable. What do they do? This is what they do. And I would check for 11 of them. 11 of them, everything. So first, goal focus. Second, the investor presentation, for example, some slides. Third, the annual report. You want to check how it works, etc. And you can check some blogs. I have here some blogs, forums for deep insights. For example, you have this website called Value Investors Club. I'm giving you everything in this video, so you just have to do the work after this. Arista Network. Okay, here. And you have somebody talking about the Arista Network. So it's a short report and you will get an opinion which is short about the stock from 2015. But that works. You will learn more about the company. Somebody has written a nice article about your company. And if you want to check another stock like Spotify, here, now somebody is long. So as of December 2022, somebody wrote a nice article completely for free, doing the research completely for free for you. You just have to read that. You don't even need to be an expert. Maybe somebody else is an expert and you will have the pitch. And you can do that for many, many companies. Value Investors Club, VIC, is a great website with a lot of great articles completely for free. Okay, let's continue. Let's continue here. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Okay, so do a shallow analysis of what do they do. Is the revenue growing? Investor presentations. You can finally do a SWOT analysis. I'm personally not a fan of SWOT analysis, but it's good to see what are the strengths, weaknesses, opportunities, and potential threats to the business. I don't like doing it, but most of the time I'm doing it because this is how you fall into traps. This is how you avoid gray areas. And I'm doing it just for the sake of avoiding gray areas, but I don't like doing this one. So take a quick look at what are the strengths of Spotify, for Arista Networks, anything. Weaknesses, okay. If you don't find any weaknesses, that's bad. Do more research. All businesses have weaknesses. What are the opportunities? So Spotify, you have, pricing power. They can increase the price. They can go into international markets. I don't know. And for the threats, who are the threats? Who are the potential competitors? You have Apple Music. In France, you have Deezer, or regulation, AI-based app. I don't know. But identify, have a shallow analysis of what is the SWOT for this one. Okay, now that you have checked, for example, 11 companies, you have eliminated half of them, you understand half of them, that's very good. So the remaining is 5 or 6. Okay, where do you continue? Here, analyzing deeper. Okay, very well. I must say that at this point, at this step 2, you will only keep the companies you're comfortable with. Because if you don't know how they make money, who are the customers, and even after your research is not very clear, if that's the case, it means that this stock is outside your circle of competence, and don't move forward. Don't move forward with companies that you don't really understand. So at the end of step 2, only keep the companies you really understand. This is what I do. So I take a pass, and personally, how I would work is out of 11, maybe I understand 3. Okay, no worries, no worries. I will continue analyzing 3 companies and move on. Move on to step 3, analyzing financials. Deep dive into the company's financial statements. There are 3 statements: income statement, balance sheet, and cash flow statement. We are talking about public markets, public companies, so they are forced to publish this one, and most of the time they are audited. They can't cheat. Look at the numbers. Look at the numbers if they are good. So for the income statement, you have the revenue, the margins, the cost, etc., the profitability over time. You can check the past income statement for the past annual reports for the past 10 years. You can have the balance sheet, assets and liabilities. So the cash, for example, the equipment, facilities, trademarks, but also the debt. So what the company owns. That can be very interesting, and I would be comfortable going deeper, for example, for the debt, to check the maturities of the debt. It means when are they going to pay off their debt, either in 2025 or in 2032. And also, what is the rate of the debt? Did they borrow at a 2% rate or a 4% rate or a 0.5% rate? This matters because debt will be a cost. You have interest expenses. And for the cash flow statement, I would check everything: inflows, outflows. So the thing that can be helpful to you, and how I'm doing it, is I use a website called Stock Unlock. And let's say I want to check Arista Network. Okay. In this website, by the way, I think you also have a link in the description below if you want to check this out. The first plan is free for Stock Unlock. Okay, I would go to Stock Unlock, go to the blue button, free form, and you can track everything. So, okay, let's start from the income statement. Income statement, that's the revenue, the cost. Let's check the revenue over time. What you see is revenue is going up and to the right. For the past 10 years, you have some things here in 2020. Okay, now ask your question. What happened in 2020? You can put in a Word document your questions, and you see that revenue has grown 30%. It's a compound annual growth rate of 30% for the past 10 years, which is a lot. But again, what happened here? If this is a tech company, how did they react about COVID and the pandemic? Okay. If you want to continue, let's check the margins, for example. The gross margins over time. Okay, gross margins started up 67 and now 64. Yeah, that's still a lot. And then in 2022, they decreased to 60%. So still very, very profitable, and now they rebound. Okay, very well. Healthy gross margins. You see that on Stock Unlock, you can check easily the trends over the past 10 years, over the past 20 years if you want. You can check the EBIT margin now. Oh, that's it. That's interesting. EBIT margin is going up and up and up, while the gross margins were going down. Interesting. You have growing EBIT margin, and actually that's not up and to the right. You have something that was happening here. New question for you: what happened in 2015? The margins went from, 21 to 17, 18, and then rebounded. So if you have a Word document with all your questions, put what happened here, and later in the analysis, you will answer this question. By the way, for every step of the research process, take a text edit, take a Word document. That's what I do, and I ask my questions along the way, because questions will be raised, and at the end of each step you try to answer these questions. And if you can't answer these questions, one, that's a very bad sign. Two, it means you don't really understand the business model. Three, it may be too complex, so investment in the too hard pile or some tricky accounting. I only invest in boring businesses, simple businesses, consistent businesses. So I don't like to see this kind of volatility of margin. So I want to see what happened first. Okay, but EBIT margins up and to the right, the business is getting more efficient. You see, compared to gross margin is going down, EBIT margin is going up. More efficiency, I suppose. Okay, and you can continue with the EPS, the earnings per share, up and to the right. Again, what happened here? New question is raised, but the earnings per share for Arista Networks has a CAGR of 46%. So that's a lot of growth. So you can check this with stock unlock very easily for the income statement. You can do the same thing with balance sheet, with the cash, for example. Let's put total cash up and to the right. That is very good news. You can do the same thing with the debt. I don't think they have debt, so yeah, minimal net debt is negative, so they don't have much debt. Long-term debt, yeah, almost nothing. Total debt here. Total debt, yeah, they have absolutely no debt. So yeah, you can check. And for the cash flow statement, I check the free cash flow up and to the right with a nice acceleration in 2022. Oh, end of 2022, so 2023. What happened here? What shifted the free cash flow generation? Again, new question for my Word document. How is that explained? Maybe they talk about this on the annual report. Maybe they talk about it in the investor presentation or in earnings calls. I want to see what happened. But free cash flow is growing 55% per year on average for the past 10 years. And you can check another metric, which is the free cash flow per share. Free cash flow per share, again, same thing, plus 40%. Oh, plus 40%. That means you have some shares dilution. Shares. Okay, that's the total number of shares. You start at 280 and you finish at 320. Okay, some little dilutions for shareholders, but don't worry. I bet it was to finance growth, and growth was real. Growth happened. So yeah, play with the numbers. That's how I do it. Check everything either on Guru Focus, or if you want to check 10 years, 20 years, you have Stock Unlock. You have FinChat that does it, but I prefer to use Stock Unlock for the key metrics like this one. So you have an understanding of all the metrics. And again, if I don't like the metrics, it's a pass, and I go to the other stock. If I don't like what I see, it's a pass, and I continue with the other one. I dismiss the idea as fast as possible. That's how I do it. So I only keep the best. I only keep the best, the greatest stocks that have no difficulties whatsoever. And even with great stocks, I mean, Arista Networks is a great company, growing nicely, nice margin, etc. Even with this stock, in 2 minutes, we raised some questions. We had some great questions. What happened here? What happened here? What about the efficiency? What about the gross margin? What is it going down? What happened in 2015? What was the rebound in free cash flow in 2023? Okay, I want to see. I want to go deeper. So I do my due diligence, annual reports, check the articles, check some blogs. By the way, if you want to check some articles, you can net seeking alpha. Here is a cheat code for you to thank you for watching my video. Seeking Alpha is a great article. It is a great website. You can have some metrics here and there. I never paid for the website, but you can pay if you want. If you want new features, you have some retail investors that wrote articles about the company here and here, and maybe you are getting interested. Okay, Arista Networks, amazing upward momentum, near-term correction likely. Okay, let's read the document. Oh no, you can't. There is a paywall, but you can still read the document with a Chrome extension. This is here. Removepayroll.com. I open here, opening archive.is, and congratulations, you remove the payroll and you can access the article completely for free. So that's a quick hack for you, a cheat code for you. Do it, copy it, steal my Chrome extension so that you can read as many articles as you want from retail investors. Don't I would say worry a little bit about the accuracy of the articles, because the articles here are written by retail investors. Sometimes you have mistakes here and there, but sometimes you get some great information. Okay, check the margins, check everything, financial statements. Yeah, look at some key metrics. I mean, I did it without reading this one. Revenue growth, EPS growth, margins, so gross margins, operating margins, free cash flow margins. You can check the efficiency with the return on invested capital, return on equity. I mean, you can do it right now. We check the return on equity. Wow, cyclical, but up and to the right. Cyclical. Again, what happened in 2018? That's a new question for you. And return on capital employed is very cyclical. What happened here? Okay, and now that it is more stable in the past 5 years, it's around 30%. 25, 45. Let's say 30-ish%, which is great. If you compare that to an average business in the US, that's better than average. So you get a business that is trading, I don't know the valuation, by the way. You get a business that is growing more than the current market, that is more efficient than the average market. That's a superior business. And a high return on capital employed, a high return on invested capital, that's very similar. A sustained return like this indicates a moat, a competitive advantage. So maybe this business is superior for a reason. I would check the qualitative aspect of this, but this is for later. So I think that's it for the step 3. Compare performance over time, so for the past 10 years, 20 years, and against competitors. I would check who are the competitors for Arista Networks and the other business models. And once I am done with Arista Networks, either I like it or I don't like it, then I pass. I move on. Let's say this one, and this one, and this one, and this one. And I guarantee 100% that if you do that for 11 companies, or if I remove the geographical constraints, if I do that for 142 companies, I will find great businesses that have outperformed the market, because these businesses are superior and they are very likely to outperform in the future. Okay, let's continue. Let's check the competition, everything, the metrics, your number. Now you have a great sense. Out of 142 companies, maybe I will deal with the remaining 10 or 15. Don't hesitate to be a harsh grader. I'm a very harsh grader when it comes to stock selection, because I only want to invest in the best companies. So out of 142, maybe I will only keep 5. You never know. But you have to do the work. I have to see if this is a good company or not. Okay, let's compare. Now, let's see the step 4. Okay, 4. Understand the strategy. Now we will talk about the qualitative aspect of investing. Analyze the company's strategic goals. Either they have growth targets, or they want to go international, or what is their capital allocation decisions. Capital allocation, I've done a complete video about this on my YouTube channel. So you just type capital allocation on my channel and you will find a video that talks about this one. Capital allocation in 2 words is what do you do with the cash flow you generate every year. Either you reinvest in the business, or you acquire a new company, like a competitor, you acquire them, you merge the 2 companies, or you pay off your debt, or you pay dividends, or you do buybacks. What do you do? What do you do with the cash you generate? And because we are only dealing with profitable companies, they generate some cash, I hope for them. What do they do with the cash? Either they want to reinvest in new facilities in Mexico to go international. Yeah, okay. And what is the expected growth rate? You can check this with everything, with the annual report, with the investor presentations. For example, we put Spotify. You know what? Arista Networks investor presentation. Most likely they will talk about their project. I'm using any investor presentation here from February 2023 24. Okay, they talk about what they do, the margins. That's the track record of the company. You have some very interesting slides. I want the future, their moat, etc., founders, leaders, growth drivers, and market opportunity. Completely for free, guys. Here, they talk about the market that will continue to grow. Okay. Now they will maybe talk about the data centers, the campus. I don't know what they do. I know it's a tech company, but I don't know what they do. The leadership, they talk about what? Share in dollars, shares in ports. Okay, very well. Data center, invest in core. Oh, that's the vision for Arista 2.0. They want to invest in core, so reinvest in the business model. They want to tap into new markets, okay, with new services, new products. And they want software as a service, so improve their business model. I'm not familiar with the business model, so I don't have any opinion on this one, but if you like Arista Networks, you are more than welcome to do the work. And they want a new vision, one operational business model. I continue. This is their future. They talk about their projects, their new offering. For me, it's a tech company. I'm afraid this is a bit too complex for me. And they talk about the new blocks for growth. Okay, about the new products they will sell. Okay, let me go down to this the end of this investor presentation, but I think we are done. If you are familiar with the business model, you will find some great, interesting words, slides about their growth project. And some companies may highlight a new buyback program, a new dividend program, so you can get what is inside the company and the plans for the future. Okay, let me continue. Growth targets, capital allocation. So now you start to become an expert of the company. You know a lot about the company. Qualitative, growth, capital allocation, growth rates at the time, the margins. You start, that's how I do it. I start from the top, step 1, and then 2, 3. You go deep dive on the numbers here. And then 4, that's the qualitative aspect. The step 4 is the qualitative aspect. Evaluate management's track record. How well have they executed similar strategies in the past? Are their goals realistic? Now I like it. This is about doing the qualitative work on a management team. That means for Arista Networks, we've seen the numbers since 2014, so 10 years ago. I want to check how the management behaved in the past. And again, we had this question of what happened in 2015. I want to see what happened in 2015. I want to see how the management reacted to this news, maybe some bad news, maybe an acquisition. What was their, their recipe for success at the time. And I want to see their plans in the past. For example, in 2014, the management may have said something like, for the past 10 years, we envision to have this amount of growth, this amount of revenue, this amount of earnings. Now, looking forward, we are 10 years in the future. Did they reach their goals? And you see plenty of companies that cheat with their numbers. And most of my stocks have had great guidance, conservative assumptions about the future, and they have all met their objectives. If they have met their objectives in the past, this is very likely that now, in 2024, if they announce a new plan for the next 5 years, for example, it is very likely that they will reach their objectives. So you want to only invest in trustworthy management. This is what it is about. You want to be aligned with management. You want shareholders to believe in you. Okay, goals realistic. So you want to check the track record of management. Look for consistency in management's plans and outcomes. Yeah. For example, if the management of a company has never done any mergers or acquisitions for the past 20 years, and now in 2024 they announce a big plan of acquisitions because we see a lot of synergies and this market is opportunistic or for future growth. Okay guys, how do you believe that? How do you know if they will succeed in their acquisitions? Because they have never done it in the past. So how can you check? For me, that's a red flag. Yellow flag, orange flag, red flag. If they have never done any acquisitions and now they start to allocate all their capital into acquisitions, I don't like this at all. I prefer management with a consistent capital allocation framework. Consistent capital. If they have done dividends for the past 10 years, I want them to continue doing dividends. If they are good about buybacks, I want them to be good at buybacks and in the future and do buybacks. I don't want management to change their mind every 3 years. I want them to believe in management, to trust management. So that's a qualitative aspect, to understand the strategy of the business. That's very important because if you don't know how the management thinks, you can't move forward with the last step. Now that you have all the information, quantitative and qualitative, the last step is the valuation. Very simple, and that's the end of this video after this, so you can do something else with your life. The next step of the analysis is once you become an expert of a company, what is the price you're going to pay for the stock? Very, very good question. So, step 5, valuation. Assess if the business is attractively priced. You can check the relative valuation. Compare the PE ratio and price to free cash flow against industry peers. Okay, let me explain how it works. You can put on stock unlock the PE ratio, price earnings ratio. We are talking about relative valuation and absolute valuation. Yeah, okay, for the PE ratio, that's a typical valuation. On average, the business would get, for an average business model, 15, 20. So if the business is a superior business, maybe it can be a little bit expensive, more expensive. So now the PE ratio at the time for Arista Networks was 30, 35. It went up a little bit, but no big deal. Went back to 17, 15 during COVID, and now it's at 30, and now it's at 50. A bit high compared to historical performance and compared to the average business model, a bit high. Is it justified because the business model is so good? I don't know. I don't know enough about this company. But yeah, you see an average of, that's the average because of an IPO with little earnings. I don't know. Let's say the average was 40. Let's say between 35 and 40. So the business on average is quite expensive, and now you have a PE ratio of 50. Okay. Let's check the price to free cash flow. Again, same pattern. We saw some cyclicality, some ups and downs, and after this, it's going up. Price to free cash flow at 45. A bit expensive. Check the competition. If they have a main competitor in the US also, is the competitor priced at a high valuation? Maybe that's the case. Okay, but I would say first, compare the PE ratio, pure number, around 15, 20, 25. Then compare the PE ratio with the past 20 years of the business. Now we saw it was up and down, but now it's a little bit higher than average. Third, check the PE ratio and price to free cash flow compared to competition, to the competitors. Compare if you have an arbitrage play. And another question, why is there a gap between Arista valuation and a competitor's valuation? Maybe that's the case because Arista is better, so more expensive. Why is it better? Do they have better service, better churn rate, better retention of clients? I don't know. That's the qualitative side of investing. You have to answer these questions, but I would personally do my own due diligence before continuing. Okay, and you can do an absolute valuation, so you can use a DCF model for intrinsic value. A DCF is very easy. Go back to stock unlock. Arista Networks, very well. There is a button here which is green. Go to DCF. Now in the DCF, that's where you put your assumptions for the future. So okay, we said that EPS grew a lot, 46%, free cash flow grew a lot, revenue grew a lot. First question to ask is, is this sustainable? Can they continue to grow 40% in the future? Most businesses can't. Actually, I'm telling you the truth, most businesses can't sustain a performance of 40%, but they can continue to grow 20, 25%. No worries. Okay, so now that's where you put your assumptions, your forecast. My forecast, let's say for the free cash flow of Arista Networks for the next 5 years, I estimate, for example, I don't know the business, but that's for the example, I would say 20%. So I think the free cash flow will go 20% with no buybacks, no dilution. And I think the price to free cash flow for this one is, I don't know, 35 or 30, because this is a better business model. Let's say 30. I have a discount rate of 10%. Yeah, I encourage you to keep the 10% as a discount rate. So if I have these assumptions of free cash flow growth for the next 5 years of 20% per year, no dilutions, and at the end of these 5 years, the price to free cash flow will be 30%. If these are my assumptions, the DCF model on Stock Unlock gives me a fair value of the current price. It gives me that right now, the stock is fairly valued. Not cheap, not expensive, but fairly valued. And if I hold this business, I can expect a CAGR of 10% from the current prices of right now, today. Okay, very well. Are you satisfied with this CAGR? Do you want more? Okay. Either you can boost these numbers in your assumption. If you think the business will grow by 25% its free cash flow, it means a CAGR of 15%. Now we are talking serious number, and it will most likely outperform the market. Okay, and if you think the business deserves a better price, a better valuation, it's even better. But most of the time, the lower the valuation, the better the results. I mean, the lower the current valuation, you have a multiple expansion, and if you have some good earnings growth, good free cash flow growth, you can have some serious numbers. So yeah, play with the numbers, be conservative, don't play with the fire, don't put this kind of numbers. If you put 50% growth, obviously it will look cheap because the future is excellent. So if you think the business can grow 30%, play it down. Be conservative. Don't put 30% in your DCF because you want a margin of safety. And I think I have a line here. Apply a margin of safety to ensure you're buying at a good price. Most of the time, you don't want to pay a fair value. You don't want to buy at a fair value. So if the business has a price to free cash flow of 30 with an expected growth of free cash flow of 30, you have a fair value which is the double of the current price. So you have a margin of safety of 50%. That's conservative. So maybe don't buy when it's expensive, don't buy with a fair value, buy when it's cheap. And you can play with the numbers to work out a clear valuation process. Decide. Now that you know the valuation, how it works, decide. Buy if it's undervalued. Buy if it's cheap. And if this is not cheap, you add to the watch list. Add to the watch list if it's overvalued but promising. Yeah, because maybe you will spend some hours thinking about this one. Step 1, 2, 3, 4, 5. You're quite happy. You know a lot about the business. You read everything. But at the end of the day, the valuation is expensive. What do? Either you remove it from your watch list. No, keep it. Add it to your watch list, the watch list to monitor over time, so that when the stock market crashes for some reason and all the stocks go down 20%, 30%, you have already done the work on Arista Networks, for example, and you can buy it at a good price. So, for example, if I think the business will grow free cash flow 20%, and the price ratio of 30. Fair value. Let's say I'm not comfortable buying at a fair value. I want a lower price. Let's say I want a margin of safety of 30%. So I would say 30%, or even 25%. So you round up to a good buying point of $300. Let's say, in this example, I'm not comfortable buying now. I will buy when it reaches $300, when it goes down. Okay, very well. And when there is a crash, in, I don't know, 6 months, 1 year, I will be comfortable buying when it reaches $300 per share. That's how I do it. And I do this, all this 5-step process. I do this for plenty of stocks. For plenty of stocks that I monitor, that I've done the work, and I know everything about these business models. I know everything about the stocks, the management, etc., the growth rate. I have done the DCF, I have done the valuation, and I'm just waiting. The hardest part is to wait. But now you know how to analyze the stocks and only pick the best ones that are very likely to outperform the market in the long term. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.